Good morning, everybody. Kirk Spano. It is the 7th of July, 7/7/25. And I wrote my semi-annual outlook and game plan, called it the semi-annual report. Volatility is going to make a comeback, or if you're at fundamental trends, same article, a lot of reasons for a bear market. This one seems to look better on the new monitor, so we will work from here. I hope you all have had a chance to read it. If you have not, get in there. If you are not a paid subscriber, this is actually free in the investment trends section at Fundamental Trends. All you have to do is trade me your email address and you can read what I have in investment trends for free. You won't get my stock and ETF picks, and you won't get our trading, which is stocks and ETFs and rare investing. Should probably just make that rare. But I want to make it very, very clear because the narratives out there are just loud and they are 80 to 90% wrong almost all the time. It's very rare that a popular narrative is true. And so when you hear people beating the drum on, say, Tesla stock, it's going to the moon, it's going to be a 2 or 3 or $4 trillion company, biggest in the world. Or if Cathie Woods buys it, you probably should run the other way, because while she's been good on the big trends, so what? A lot of people are. She's a shit stock picker. Very, very bad at knowing when to buy things and when to sell things. The performance proves that. The only reason one of her funds has done well is because of Bitcoin. In any case, I want you to think about what really is going on with tariffs. I want you to consider that debt is a bigger problem today than it's ever been before. And I say that as a guy who for 30 plus years said, don't worry about the debt. I was very much in the Dick Cheney camp of debt doesn't matter, but we have since jumped the shark on debt, and we have expanded it to the point where I think that this tax bill, tax and spend bill, or untax and unspend and respend and redirect bill, the big skim bill, as I've been calling it, I think this is going to tip us over the edge. I think that the combination of the tariffs and the debt blowing out is something that people aren't putting together. And I think you need to, because the debt requires countries and people to lend the United States money at the US Treasury level, and the consumer and business debt needs a strong economy to be able to be serviced. And one of the statistics that you need to know is that 80% of the people, give or take, have not really done all that well since COVID, and really in the last 20 years. So we now have a extra generation worth of people who have not only not gotten ahead, but have fallen behind because of inflation, because of stagnant wages, because of money flowing uphill. Now, we have about 20% of the population that has done pretty well, and that is in relative standards. I would be categorized, I think, as a 2%er, and I feel like, relative to where I was as a kid, and 3 times being essentially broke as an adult, I've made a lot of money pretty fast. And relatively speaking, it feels much better than when I was broke. But one of the things we know is that the top 10% of the population accounts for virtually all the spending in the economy above subsistence level spending. Think that through. Imagine what could happen if we went back to having 60+% of the people getting ahead rather than 10 to 20% of the people getting ahead. I don't know necessarily what changes it. I have some ideas. You've heard them before. But I know that this current bill that got passed will not pay for itself. 99.9% sure. It would take an act of God or aliens or the whitest white swan you've ever seen for this tax bill to pay for itself, or to even come close, really. The tax cuts for people in the top 2% are great. I'm going to probably get another 10 or 20 grand a year out of it, which I will pump straight into traveling. especially since people are doing less of that suddenly. All that money is going to get spent in France next year. Not all that productive. It's not going to capital expenses. It's not going to hiring labor. And that is the nature of the types of tax cuts that we're seeing. When Ronald Reagan cut taxes and then did not cut spending, the first time that we went to a tax cut and deregulatory regime post World War II, the deficit, the debt, and GDP all grew about the same. There was no net gain in real terms, but it was the closest we ever got. When George W. Bush deregulated and cut taxes, we got the financial crisis. And the response to the financial crisis, which included QE, quantitative easing for the first time, resulted in the debt rising much faster than GDP. Basically, spending $1.20 through borrowing to grow GDP $1. President Trump did the same thing as George W. Bush, 2017. Again, it did not pay for itself. Not as bad as the post-financial crisis, lack of growth to debt. And this bill projects out to see the debt increase $5 or $6 trillion over the next decade. And that's if we don't get a recession. If we get a recession, it's worse. And that is into a time period where the tariffs, here's your connection, have pissed off basically most of the planet. Now, I'm not going to argue that we shouldn't have some import tax, to be honest, but it should be small. It should be like 5%. Scott Bessent actually once mentioned 3.5%, which is a weird number, but I don't have a problem with an import tax that you can negotiate away with a free trade agreement. That would have been the smart way to do it rather than the imbecilic, completely dumbass way that they have calculated the tariffs. I mean, honestly, this idea that anything that's going on is brilliant is insane to me. And I will put that into context as this dude bankrupted a casino. So you can get all bent out of shape because you're being political. Well, fuck that. I'm not being political. Excuse me, zuck that. I'm following the money. And I'm using the available evidence. Nothing to do with ideology. I'm a centrist and generally a hawk. I have no beef killing bad guys. But more money is going to flow uphill here than ever before. And they are going to pump Bitcoin after the next correction because they're going to print money. I have almost no doubt this is kind of the plan. The rhetoric that comes out of the White House about lowering interest rates is so stupid and so over the top misdirection that it makes me sad that so many people believe it. Sad. Because it means that our education system has just fallen to shit and that the social media and alt media narratives that play on emotions and rationalizations and a lack of introspection have become so in control that we are much more likely to break things than fix them. And I sit here as an investor thinking to myself, well, that sucks for them. I'm going to take their money in the stock market. Anyway, back to what's going on. I want you to read this whole article because I took the time. I spent an entire weekend basically writing this. It was up to 8,000 words at one point, cut it down to 4,000 because we're going to get a debt crisis. And I don't know exactly the timing or the shape of the curve, but if I had to guess, if I had to give it my best analysis, which I am, I would say this. Sometime between now and next spring, you're going to see a run-of-the-mill bear market. What is a run-of-the-mill bear market? It's a stock market that drops 15 to 30%. That's run-of-the-mill. It's not a big deal, right? That's just a correction. It's the market exhaling. Oh my God, what if I lose 30%? Well, you shouldn't be in the stock market if that bothers you. Or you should manage your money a little bit better, which means, as I say in the article, your best hedge is to raise a little bit of cash. Sell into the market strength. We know, and I didn't even put, this is something I took out because I just get tired of repeating it. From a seasonality standpoint, the stock market weakens by the end of July, and August and September are the worst months of the market. And in bad years, that carries forward into October. We are at historically high valuations. Buffett indicator is at a record. All the other PE metrics are super high. The Case-Shiller PE is at the highest ever, which indicates that we'll probably have around a zero return on the S&P 500 over the next decade. I go on to say that I think that that's probably not quite true because we're going to get quantitative easing again. And all this quantitative easing since 2008 has made price to earnings ratios higher in this era, in this monetary regime, than pre-financial crisis, and especially pre-2000. So I'm not so sure that we're going to get a return in this range over the next decade in the S&P 500. My guess is that it's in here somewhere, one of these yellow boxes. So below average, but not zero, because they're going to print enough money to keep it up here. And one of the things that you have to realize, and I've showed this chart in the past before too, tax receipts are almost completely correlated to the price of assets. You can see that in a chart of the United States tax receipts versus the stock market, or take a look at California's, and they're very leveraged to QQQ. When the price of assets go up, there's more to tax. When the price of assets go down, which usually corresponds with a recession, or at least an economic slowdown, there's less to tax, which is why if we get a recession, we are in some deep, deep doo-doo. And if we get stagflation, it could actually turn into a depression. I believe that the odds of the depression have risen this year, and I don't think it's a small increase. I think the risk of stagflation and deflation, I think the risk of stagflation and a depression have risen from almost zero, right, slim and none, to it could happen. How would I handicap that? I don't know, 10 to 20% likely. Can't bet on it, but you should be afraid of it. If you had a 10 to 20% chance of winning the lottery, would you stop playing? You wouldn't. And in a world where we have gamified the stock market and cryptocurrency, and we have really taken the casino concept of asset management and expanded it like the Las Vegas Strip over the last 100 years, 80 years. And retail investors, the dumb money, the FOMO crowd. See, the dumb money refers to people who just follow the trend. And we know that most people are bad at doing that. So they just live in the moment. They don't look forward. They don't understand history. The dumb money is getting very exuberant again. Anytime it gets to the top of this range, you get a correction. So when I talked about the technical indicators in here, and I explained what everything on this chart made, what it indicates, it's pretty easy to see that it won't take a lot of shock to push us into a run-of-the-mill bear market. Now, what could it take to push us into that 10 to 20% range where everything collapses? I don't know. Anybody who says they know is either arrogant or just spinning a narrative because they're selling a subscription. Well, they might just be dumb. There really is a lot more dumb out there than we care to admit. The odds of the S&P 500 making a run at 5,500 on SPY, I think is extremely high. That would just be retesting the lows from this year. But I think this area over here, where all this volume is, we're going to hit it eventually. Will we hit it in the next decline, or will it take longer? Again, I don't know. But what I do know is that risk has grown, and you need to be very aware of that. If you truly are concerned about preserving your wealth, and we know that the S&P 500 is at one of the 2 or 3 most expensive spots in history, if not the most expensive, on a valuations adjusted basis, you ought to be dumping S&P 500 correlated investments, in particular ETFs that are diversified across the S&P 500, in particular SPY and VOO, and IVV, I think is the other one. You should not own an S&P 500 fund right now. This is one of the rare times where that makes complete and utter sense. And I know that the Bogle has just you can't beat the index. Bullshit. I've crushed the index in my career. Not every year, but the up years are so up. And the fact that I know how to sell options, which grinds out all these huge premiums, the idea that you can't beat the index is just insane. The reason why giant funds don't beat the index is because they just have too much money to move around. They're not nimble enough. And the rules are actually set up against them. They can't do some of the things we can do, and they certainly can't move as fast because they'll change the price of an asset just by making a trade because they're too big. We, as little guys, right? As 5-figure and 6-figure, 7-figure and 8-figure investors. Not positive that we have a 9-figure investor. I'm trying. We don't impact the market. We kind of have impacted a couple of our micro cap and small caps a little bit. We've helped stabilize some of the stocks. But until you get a big wave of investors or a giant investor, price doesn't do a lot. Why did AST Space Mobile go from $4 a share to $45 a share in 2 years? Was it because Kirk Spano said something or bought a few thousand shares? Told you, nah, our group is too small. My influence is to under 1,000 people. But there's a community on Twitter, X-Twit, and they're connected to trading rooms and Discord rooms that have reached 6 figures worth of people. Kind of like Tesla did, 7 figures of people there, right? And you get that wave. And one of the things I mentioned in here is I talked about the millennials, right? If you don't understand that the millennials are the most important money in the market, you just aren't paying attention. And you miss that class, apparently, in economics. The money at the margins is what moves price, right? The last buyer or seller is who impacts price the most. The money at the margin now is 100% the millennials, at least domestically. And then you have international investors who are, by and large, very sophisticated. And I will say this. I have said this before, and I'll say it again. The millennials understand the investment toolbox, at least the traders, much better than the boomers ever did, and much better than the people who just glom on to buying the S&P 500. Now, if you don't have time and are unwilling to do the work and prefer to chant something rather than do research, if you dollar cost into the S&P 500 over 30 years, you'll do fine. You'll beat inflation. You'll probably average around 10%. Because, again, the government can't afford for it to go down. The only way the government can afford for the stock market to truly be free again, as in freedom, is if they started spending within their means, which would mean that they weren't stealing as much. The big skim bill is going to result in trillions of dollars being moved mostly to wealthy people. As an investor, I have to recognize that. I have to get over any ideology or bias, rationalizations of my existence in the universe. Say, okay, I'm just going to follow the money, right? I'm just going to follow the money. And if I just follow the money, there's only one conclusion I can come to, and that's that the system is skewed towards the wealthy, and it just became more skewed to the wealthy. I have to play by those rules. And if I want to get my beak wet, I have to do basically what they're doing. I can't say, oh, what do you think of this company? And it looks pretty good. I'm going to buy some. Zuck that. Stop thinking that way. Invest in the big secular trends. Try to find value. And remember what Charlie Munger said, all investing is value investing. Just depends on what you're buying, where you find the value. Sometimes you get your margin of safety from just buying something cheap against its historical valuation, right? We should have probably have bought NVIDIA a few months ago. We're going to get another chance. By the way, he talked about robotics today. What did I just tell you I'm looking at? There are going to be several robotics-related stocks in the new punch card stocks, which, by the way, I'm combining the two lists back into one article again. All the punch card stocks will be in one article. It'll be easier for me to pin that to the top of the blog and the stock and ETF trends here. Be easier to look at over on margin of safety. And that's almost done. It's a lot of reading. Even with AI, it's a lot of reading. But I gave you a summary before I left for vacation. Pretty much holds. There'll be a dozen new names in the new list, a few removals. But if you invest in the big secular trends and understand where the next bubble is going to come from, you can ride that next bubble. Again, we've talked about Paul Tudor Jones before. Everybody says how they hate bubbles, but I love bubbles. Get in on that bubble and ride it up to the top or close to the top. Probably sell a little early. Technical indicators will help you. And this is why, at a minimum, you need to have a cursory understanding of technical indicators and what I'm talking about when I talk about technicals. Because if you don't respect technical analysis, what I always say, you shouldn't manage your own money. You don't need to be a chartist, especially in the day of AI, but you have to be able to read it and understand what you're looking at. or understand the range of things that you could be looking at. Again, that's important. Game theory, scenarios, tactics. There are no magic answers. There is no technical analysis that is purely perfect. There is just a confluence of different technical indicators that say the same or similar things. And that is a great clue, like finding Colonel Mustard in the library with the candlestick. He probably is a bad guy. And it helps with fundamental analysis because our fundamental analysis is inherently flawed because we're human and we make mistakes. Even AI makes mistakes, actually a lot of them. That's why you always have to quadruple check everything that AI tells you, to the links, and read them, cross-check them. Because all AI is doing is regurgitating what's out there. And that's good because it saves you a ton of time for finding all those links and all those sources. But it's not gospel. I want to point out something that I think is going to be the next bubble. So I've known Lynn Alden since before she was famous. So she just wrote this article, The Rise of Bitcoin, Stocks and Bonds. I don't entirely agree with her here, but it is important that you read this because it gets to the narratives that are out there, and those narratives are going to drive the next rally in Bitcoin, which is going to come in spectacular fashion when they do the next round of monetary easing, probably quantitative easing next year, because they're creating a debt crisis. I'm telling you, President Trump doesn't care if he causes a debt crisis because he's just going to print his way out of it with a hand-picked Federal Reserve chairman. I don't think Scott Bessent cares. He's a private equity and hedge fund guy. He knows what's going on too. He's in on it. They are going to pump certain things. And I have told you that I think that Bitcoin is going to 300,000. This next rally is going to be the one when it happens. Now, will it get back down into the 70s for me? I don't know. There is so much FOMO in Bitcoin that I think you have to buy any little dip under 100,000 or at least sell cash secured puts, which is my plan. I still have my cold storage Bitcoins. When Bitcoin gets to 300,000, I'm going to think about selling some of them. Depends what the momentum is. And that is something technical indicators help you understand. If you respect the technicals, you understand momentum better. And everything in investing comes down to those momentum-driven rallies. I mean, almost nothing just grinds its way higher for decades. It's peaks and troughs, spikes and collapses, fear and greed. Your job as an investor isn't to feel comfortable. Your job as an investor is to find good investments that will pay you over time. And for me, the time frame that I look at the most is that 3 to 5 year time period, where I shorten it up a little bit to 2 or 3 years, because that's knowable. You can make a pretty good estimate of what is going to happen over the next several years. You don't know what's going to happen a decade or two from now, and you don't know what's going to happen tomorrow. It is only really that intermediate time frame where you can have some direction because you can see where the money is moving. You can see how capital flows are moving. You can see what the government is pushing up and down. And we are seeing the most crypto-friendly government, not only that we've ever had, because that's not a very high bar, but most crypto-friendly government than I think anybody ever supposed we would have. And what's weird about it is we have learned that quantum computing is inherently bad for blockchain. There's going to have to be an overlay to protect it, a security overlay, because otherwise a lot of people are getting their Bitcoin stolen. That's why I don't keep mine on the internet. I want you to read this article about Bitcoin because if you haven't gotten involved yet, if you didn't ride it from 20 to 100 with us, I think you're going to get another chance. And I think it's only going to be about a triple. I think all the talk of it going to 1 million is talk. I think it's part of hyping the narrative. Lynn talks about the valuation of the Bitcoin treasury companies. She doesn't really talk about something that I think is important. If Bitcoin is fundamentally a commodity, which is how it's regulated now, CTFC, that means that these treasury companies, depending on how they run their business and what they claim to be and how they do their taxes, are going to have to be regulated as brokerages at some point. Maybe not under this administration, which has been trying to get rid of all the regulators, right? Because it's much easier to steal if nobody's watching, right? If there is no Elliot Ness, right? Al Capone is still out there, or at least his great-grandchildren. They've gotten rid of all the Elliott Nesses, or at least a lot of them. It is easier to cheat in the crypto markets and the corporate markets and taxes than it's ever been before. And so you're going to see a lot of cheating. If it's easy to cheat, people will do it. And my one gripe with the millennials is that they are very good at moral relativism. They're very good at saying, well, this helps me, so maybe it's not so bad. To me, that's the drawback of that generation, which is not the way the fourth turning was supposed to work. So we'll see. Valuations are high, and there is any number of things that can cause a big correction. International investors have been using algorithms, and big investors have been using algorithms to sell into the retail buyers. Why do they use algorithms? Because the algorithm can trickle into the market without changing prices. So retail has bought more than international sold. And I think that that is going to reverse at some point and cause an even bigger correction, because retail will not be able to keep up with the international selling. And the international investors are very sophisticated. They will buy back when it's low, which is what we need to do. You'll notice, if you took a look at one of my tweets a while back, that mutual funds are basically fully invested again. There is no cash on the sideline from them anymore. A lot of the traders who were short a couple of months ago are long now. That short squeeze appears to be out of the way. The so-called dry powder and money market accounts is almost exclusively 10 percenters and richer. A lot of us are buying real estate because that's tangible. I'm not sounding to sell almost everything alarm yet, because your catalyst-driven stocks, the ones that you know like a brother or sister, right? You need to know them. Still have a lot of upside, especially the ones tied to the big secular trends and those that the government is pumping. You should stick pretty much exclusively to the big secular trends. And then if you want to get involved in the pumps, go ahead and do that. Bitcoin is going to get pumped. When they print money next, or when they cut interest rates, when they devalue the dollar even further, Bitcoin's going to scream. It's going to make a run to 300,000. Now, that's only 3x from here. It's not as good as the 5x that we just had, but it might be the best thing out there, other than those catalyst-driven stocks. And you can certainly trade IBIT, but it is not a forever holding. And I have actual Bitcoin, so I would just custody those off, right, the internet. You just don't want any internet access to it. Without asking about specific stocks, what kind of questions do you have? I think I've been very clear about how I feel about S&P 500 correlated funds. Yeah, you should be getting out of them. I think you should be 100% out right now. As far as stocks that are highly appreciated S&P 500 companies, you have to ask yourself the question, do I think the stock can drop over 20%? Why is 20% important? Because that's the capital gains rate. If a stock has less risk than 20%, it's highly appreciated, and you don't want to pay the taxes, then you don't sell. But if you think the risk is greater than 20%, and you're not close to a step up a basis because you're not almost dead yet, then you should consider selling at least some of it. So if you're 55, like me, and you own Amazon and you're up a zillion percent, you should sell some of it, because the risk is clearly more than 20%. And I love Amazon. I would buy Amazon if we got under 100. Remember, Jeff Bezos has been selling a lot of it. He knows that company pretty well. Someone asked, is it worth trading currencies or international ETFs? Well, two different species there. That's like saying, should I hunt Bigfoot or the Loch Ness Monster? All right. If you're not an expert on currencies, don't zuck with it, right? Currencies are a great market to trade if you're an expert, but just like every other trader-driven thing, 80% of the traders don't make any money. So if you cannot say that you are a top 20% trader in a particular thing, don't freaking trade it. It's just like poker. I'm a top 20% player, and I pay for my vacations usually, not this year, but I'm not a pro. And the top 1 or 2% of all poker players make all the money, just like in investing. I'm trying to get you all into the top 20% as investors, hopefully the top 10% as a 2%er, trying to teach you what I know. And I've done pretty well not having inside information. The way I describe things to you work, and it took me a very long time, decades, be comfortable with the idea that I was mostly right most of the time. And it comes from having a process, something that I was taught as a kid. Just make good small decisions over time and it snowballs. It's kind of like thinking in bets, but the book Thinking in Bets, you should read it. It's linked in my book list. Tom Lee always thinks the stock market is going up. He has never been bearish that I know of. He's neutral or bullish, always, all the time. And there is a possibility the stock market goes up, but it would be purely on YOLO FOMO. There is no fundamental support for the stock market rising. And the idea that people have about M2 going up is completely misplaced. I have explained why M2 is back to the COVID peak. It has nothing to do with printing money. Zero. The Federal Reserve has been unprinting money and now just got back to neutral. They have been recycling already printed money because they haven't financed out any of the U.S. debt to a longer duration. They just keep renewing it. And now they have cut the bank SLR, the reserve requirements. So a little bit of money is going to trickle into treasuries. It's not enough to move the needle. It's enough to make the banks weaker. It's not enough to support the U.S. Treasury market. We've talked about the basis trade breaking down. And again, I will repeat myself for the third or fourth time today. If international investors don't buy our treasuries, interest rates go up and there's a credit crisis. We will respond to that by printing money. That will cause inflation. Everything that you saw from COVID is probably essentially, with the exception of the pandemic part, going to happen again. We're going to get a big correction. We're going to get bailed out. We're going to get inflation. And then the baby boomer retirement crisis hits in 2029-30. And Trump will blame that on somebody else, even though he has failed to do anything to plan for it, just really like everybody else has failed to plan everything to do with it. And then we will do even bigger quantitative easing in 5 or 6 years. And hopefully, we're smart enough to actually fix the system. If the Democrats are in charge, it'll mostly get fixed with a little bit of waste. If the Republicans are in charge, in my opinion, it'll just be part of the same grift. I will invest accordingly. That's what my analysis tells me. It has nothing to do with party. I've worked for both of them. I've given to both of them. And since last year, I've stopped giving to either of them. I've completely stopped participating in the politics. Why? I don't need them. I can read what they're doing. I can stick my money grabber in there without having to be one of them. And then I just have to do something good with the money. So I can bitch and moan all I want about how things are broken, or I can just understand it, tell the people who ask what I think, and go out and make money. To the extent I have a small itty-bitty power of the pen in the podcast, I tell you what I think. This is what I think. Maybe I'm wrong, but I think there's a financial crisis coming. I think it probably comes in 2 parts, big and bigger. I think that we print money to get out of it both times, big and bigger. I think that creates a lot of volatility that you can trade against over 2, 3, 4, 5-year periods. And I think that anybody who's still thinking that you can just buy the good stuff is going to lose money. You have to figure out what is the best stuff, because virtually all the money is made in a handful of investments. We saw that with the Magnificent Seven, Nifty 50, right? Gains are concentrated just the way it's worked, probably the way it'll always work. You have to ignore 80% of what's out there. I will tell you how to make money. Either have a spectacular job or own a business, buy real estate, and have a concentrated stock portfolio. That's how you make money. Now, you can invest in the S&P 500 if you want to preserve your purchasing power, but you really won't make a lot of money. You'll just beat inflation by a few points. But if you want to make 15, 20% on average a year, rather than the 8 or 9 or 10 in the S&P 500, you can't just invest in the S&P 500. You need a big paycheck, you need some real estate, and you need the stuff that does best, while ignoring almost everything else. That's it. That is the secret of generating excess returns. Don't invest like all the know-nothings who buy the S&P 500 on the theory that they don't know anything. I mean, come on. They basically say that I can't be better than average. That's what the S&P 500 is. It's the average. If you don't think you can be better than average, don't manage your money just by SPY. If you think you can be better than average, do what I'm telling you to do. Either own a business or have a big paycheck, right? Easier said than done. Buy some real estate. I think, frankly, everybody should have 2 or 3 properties. Figure out how that works in the context of your family. and stick with the very top best ideas and ignore everything else. And don't lend money to losers. That's kind of an important one, too. I learned that the hard way. Yeah, Annie Duke, Thinking in Bets. Read it. Read Schiller's Narrative Economics as well. And read Getting Started in Technical Analysis. It's really all you need. You don't have to read everything else that I've read. Just understand how to look at technical analysis that's presented to you and be able to think it through in a tactical game theory approach. These are the scenarios that are most likely. These are the scenarios that aren't very likely, but could hurt a lot or help a lot. And understand that we are within 5 years of a debt crisis, and there's probably a warm-up act soon, followed by QE, followed by inflation, followed by the real debt crisis, followed by more QE. All right, read Lynn Alden's article, read mine, punch card stocks this week, although it's not that important because there's not really much to buy right now. Play defense. Very unlikely this market breaks out. Doesn't mean it can't happen. If it does, it'll be the last puff on the cigar. All right, have a fantastic day. Enjoy some weather.